How could a bank be worth $16 billion one day and then close to zero 2 days later? As you might have guessed, I'm talking about Silicon Valley Bank, a bank that was one of the largest in the nation just a few days ago, but depending on what happens, might not exist in the future. The easiest way to make sense of what happened to this bank is to think of its demise as being caused by four separate but connected acts, almost like some kind of Greek tragedy. The first act was the tech bubble. This took place in 2020 and 2021. Obviously, the world was very different back then. We were in the early days of the COVID pandemic, and the Fed had just cut interest rates to zero in order to support the economy. The federal government had sent out thousands of dollars worth of stimulus checks, and a lot of people were stuck at home where they used new technologies to work and to entertain themselves. It turns out that this was the perfect environment for a bubble to form. With interest rates at zero and demand for tech products and services going through the roof, investors pushed stocks of technology companies into the stratosphere. That enthusiasm filtered down into the market for earlier stage tech companies as well. These tech startups were funded by venture capital firms, who were suddenly willing to invest millions or even billions of dollars to any tech startup that had a promising story. Flying taxis, space tourism, quantum computing, you name it, it got funded during the easy money era of 2020 and 2021. So you had all these startups raising a ton of money during those years, and where did they put the money? They put it in Silicon Valley Bank, the preeminent bank for tech startups. SVB had deep connections with the tech startup ecosystem. It went above and beyond to cater to young up-and-coming tech companies, doing whatever was necessary to get them to bank with SVB. The bank did business with about half of all VC-backed companies in the US. So between 2020 and 2021, as the tech bubble inflated, Silicon Valley Bank's deposits more than tripled, from $62 billion to $189 billion as its tech startup clientele became flush with cash. But then came Act 2, SVB's investments. With tens of billions of dollars coming into the bank on such short notice, Silicon Valley Bank had to quickly decide what it wanted to do with all this new funding. More deposits meant that SVB had more capacity to make investments of its own. But what kind of investments it made was totally up to the bank. It could have tried to make loans to its customers. That's what a lot of banks do. But the startups that SVB catered to already had a lot of cash from their VC investors. They didn't really need bank loans. SVB also could have bought really safe government securities like treasury bills. The great thing about T-bills is they're issued by the US government and they hardly fluctuate in price. They get paid back in less than a year, so they're essentially the safest investments in the world. The problem is, with interest rates at zero, you couldn't really make much money on T-bills. They were paying almost nothing in 2020 and 2021. So in order to generate a little bit more interest, somewhere between 1 and 2%, what SVB did was buy bonds that take much longer to get paid back, like long-term treasuries and mortgage-backed securities. This enabled the bank to generate higher returns, but with higher risk, since long-term bonds are really interest rate sensitive. Their prices go up a lot if interest rates go down, but their prices go down a lot if interest rates go up. Making these investments would prove to be a crucial mistake for SVB. In 2022, the good times came to an end, whether it be because the Fed started to hike interest rates aggressively to combat inflation, or people just realized they were being irrational for 2 years during the tech bubble. It all came to an end in 2022, and the demand for tech investments plunged. First, tech stocks within the public stock market crashed, and then that filtered into the private markets where tech startups operate. All of a sudden, venture capitalists weren't willing to mindlessly plow money into all of these startups, many of which didn't make any profits, and some of which didn't even have sustainable business models. Less money for startups means that they had less money to put into Silicon Valley Bank. And what money the startups did have in the bank, they started to pull out in order to pay their workers and to pay other expenses. After peaking at $198 billion in March 2022, SVB's deposits dropped to $165 billion in February 2023. So this was going on, and it wasn't good for the bank, but no one thought the problems facing SVB were that severe. But then late last week, the ratings agency Moody's called up SVB and told them that they were about to downgrade the bank's credit rating. Moody's saw that the value of the investments that SVB made over the last couple of years had dropped significantly, and that they weren't generating much income for the bank because they were purchased when interest rates were much lower. At the same time, Moody's noticed that SVB was having to pay higher and higher interest rates to its customers on their deposits to keep them from taking money out of the bank. This was squeezing the bank's margins. So the threat of the credit downgrade from Moody's caused SVB to scramble. The bank came up with a plan to sell $21 billion worth of its long-term assets. assets. It would then reinvest that money into shorter-term assets that were less volatile and had higher interest rates. So earlier this week, the bank sold the assets, but it lost $1.8 billion on the sales. Then on Wednesday, SVB came out and said that it was trying to sell $2.25 billion worth of its stock to investors to make up for those losses. But instead of reassuring investors, the plan caused panic. That brings us to Act 4, the bank run. For most people, the news of SVB selling assets at fire sale prices and then trying to raise money through a stock offering completely came out of left field. People thought they had their money in a safe, reputable bank. So once they learned that that might not be the case, everyone started to pull their money. VC firms advised the startups that they invested in to take their money out of the bank ASAP. The Silicon Valley tech community, which is all kind of tuned into the same news and follow the same people on Twitter, all acted at once. On Thursday, depositors at the bank tried to take out a whopping $42 billion collectively. That completely overwhelmed the amount of cash that SVB had on hand, making the bank insolvent. As a result, California authorities took over the bank and handed it off to the FDIC. Silicon Valley Bank had failed. So that's Act 4, and you could say the story is over. But there might be some more developments in the coming days and weeks. Starting on Monday, anyone who had money in SVB that's covered by FDIC insurance, which means deposits of $250,000 or less, will have access to that money. But anyone with uninsured deposits, meaning deposits above $250,000, will have to wait to find out how much money they're going to get back. That's kind of a scary thing, especially since 85% of the bank's deposits were uninsured. Remember, the customer base at SVB was mostly tech startups. They had tens of millions or hundreds of millions of dollars at the bank in many cases. Now they don't know how much money they'll get back and whether they can even pay their workers starting next week. There's two pieces of good news though. One is that the FDIC is trying to find a buyer for SVB that can take over the bank in its entirety and resume operations seamlessly. If that happens, then all depositors will most likely be made whole. But even if that doesn't happen, maybe because the bank's assets are now less than its liabilities, or for whatever reason SVB can't find a buyer, then the FDIC will sell its assets piece by piece. Even in that scenario, uninsured depositors will most likely get their money back because the government wants to reassure the public that their money is safe at their local bank. They don't want to see contagion where bank after bank fails because people are worried about their money. In most cases where banks have failed in recent years, uninsured depositors have been fully compensated. So that's good news. But still, like I said, it's kind of scary that the 16th largest bank in the United States went under and most of its deposits aren't guaranteed to be paid back in full. They probably will be, but it's not guaranteed. So some people like hedge fund manager Bill Ackman are now worried that we might see similar bank runs at other banks that have a lot of uninsured deposits. Now, don't get me wrong, that is possible and financial panics do tend to feed on themselves and spread. You never want to rule anything out. But SVB was also very unique in that it catered to a single, very volatile industry. When that industry went bust, it caused a lot of strains on the bank's customers. Most banks, especially the top 10 banks in the US, which hold over half of all deposits, are much more diversified across industries and across the types of depositors they have, from regular people to small businesses to large businesses, etc. So those big banks, which are also considered to be too big to fail by regulators, are safe. Where we might see strains are in other banks like SVB, which focus on a homogeneous set of customers that are going through tough times. So we'll see what happens. The downfall of Silicon Valley Bank and the crypto-focused bank Silvergate earlier this week probably aren't the start of a 2008-style financial crisis. But we have to stay vigilant, and the government has to do all that it can to reassure the public that these are isolated events. Hope that helps, and follow for more investing insights.